Surveys of institutional investors consistently find that the majority of allocators who hold or are considering crypto positions lack a formal, board-approved digital asset investment policy. For traditional assets, equities, fixed income, alternatives, investment policy statements are standard governance infrastructure. They define risk tolerance, allocation ranges, rebalancing rules, eligible instruments, and custodian requirements. The absence of an equivalent policy for digital assets creates significant fiduciary exposure. Allocation decisions made without documentation of process, analysis, and approval are difficult to defend to beneficiaries, boards, or regulators when outcomes are adverse. This video provides a complete framework for building an institutional digital asset policy from scratch, covering asset classification, eligible instruments, allocation parameters, custody requirements, tax treatment, rebalancing rules, and board approval processes. Whether you manage a family office, a registered investment advisory firm, or an endowment, a documented crypto policy is the difference between a defensible fiduciary position and an improvised one. The former is the professional standard. An institutional digital asset investment policy requires 7 components to meet the governance standards expected of fiduciary investors. The first 4 establish the strategic framework. Investment rationale. Document with specificity why your institution is allocating to digital assets. The justification should be data-backed, referencing the portfolio diversification evidence, the monetary policy hedge argument, or the expected return contribution, and explicitly connect to the institution's overall investment mandate. A vague rationale like crypto exposure is insufficient for a board-level document. Asset classification and eligible instruments. The policy must explicitly enumerate which digital assets qualify for investment. For most institutional mandates beginning their crypto journey, restricting eligible assets to Bitcoin, Ethereum, and qualified crypto ETFs provides clear boundaries. Any asset not explicitly listed should be treated as excluded by default. Allocation range and target weight. Define the strategic target and the permissible band. A 2% target with a 1 to 4% permissible range, with quarterly calendar rebalancing and threshold rebalancing triggered at 4% maximum, is a defensible and practical starting configuration for most mandates. Custody requirements. The policy must specify minimum custodian standards, qualified custodian status, audit certification, insurance minimums, and key management architecture requirements, so that custody decisions are governed by policy rather than individual judgment. 3 additional sections complete a robust institutional digital asset policy. Section 5. Risk management and monitoring. Define specifically how crypto exposure is tracked and reported. On-chain analytics platforms, Glassnode, Chainalysis, or equivalent, provide portfolio-level metrics including unrealized gain or loss, on-chain activity around custodied assets, and market cycle indicators. Custodian reporting should be reviewed monthly, with a quarterly investment committee review of crypto allocation relative to policy targets. Critically, define mandatory review triggers. If the crypto allocation falls below the minimum band due to market decline, or rises above the maximum band due to appreciation, the committee must convene to determine the rebalancing action. Section 6. Tax treatment framework. Specify before the first trade which cost basis method will be used, FIFO, HIFO, or specific identification, and which tax platform will track positions and generate Form 8949 output. Define the tax loss harvesting policy, where the systematic harvesting will be conducted, at what loss thresholds, and how wash sale adjacent considerations are managed given crypto's unique treatment. Section 7. Governance. Define who approves the policy, typically the full board or investment committee, who approves individual custody relationships, and who authorizes transactions above a defined threshold. Annual policy review with amendment procedures ensures the policy remains current with regulatory and market developments. A 5-stage policy development and approval process provides the governance documentation that investment committees and regulators expect. Stage 1 is the investment team research phase, conducting the quantitative and qualitative analysis of digital assets as a portfolio allocation, reviewing peer institution practices, and developing the initial allocation model with scenario analysis and drawdown stress testing. This analytical work is the substantive foundation for everything that follows. Stage 2 is legal and compliance review. The draft policy should be reviewed by counsel with expertise in SEC investment advisor rules, ERISA if applicable, state regulatory requirements, and crypto-specific regulatory frameworks. This review identifies any prohibited instruments, reporting obligations triggered by crypto allocation, and custody requirements imposed by applicable regulations. Stage 3 produces the complete draft policy integrating all 7 components, including a shortlist of qualified custodians and the recommended allocation parameters with supporting analysis. Stage 4 is investment committee review, typically a 2 to 3 hour working session where the investment team presents the policy, walks through scenario analysis and stress tests, and addresses specific questions from committee members. Stage 5 is formal board or committee ratification, followed immediately by custodian onboarding and the first phased allocation. Each stage should be documented with meeting minutes and approval records. This documentation is the audit trail that supports the fiduciary defensibility of the entire process. The fiduciary argument for a formal crypto policy is not primarily about optimism regarding the asset class. It is about institutional process. A family office CIO articulated the point clearly. An investment policy that fails to address digital assets in 2024 is analogous to an investment policy that failed to address alternative investments in 2000. The asset class exists and is growing. Institutional capital is flowing into it. If your policy is silent on crypto, and a committee member, beneficiary, or regulator asks how the institution's digital asset allocation, or absence of allocation, was decided and documented, what is the answer? Ad hoc judgments unsupported by documented analysis and formal approval are difficult to defend in retrospect, particularly if markets decline. The formal policy does not commit the institution to making a crypto allocation. It creates the governance infrastructure to make, or explicitly decline, that allocation with full fiduciary documentation. Many institutions will complete the policy development process and conclude that crypto does not meet their risk tolerance or mandate parameters. That conclusion, documented in the policy, is itself a defensible fiduciary position. The absence of any considered position is not. Investment committees reliably raise 3 objections to crypto allocation, each of which has a principled analytical response. The first objection is the no intrinsic value argument. The correct response is to disaggregate Bitcoin from Ethereum from the broader crypto market. Bitcoin's value derives from its properties as a non-sovereign fixed supply asset, properties comparable in their analytical framing to gold, which also lacks cash flows but has commanded institutional allocation as a store of value and inflation hedge for decades. Ethereum generates verifiable fee revenue from economic activity, a genuine cash flow that can be modeled. The no intrinsic value argument applies to a subset of the crypto market, not to its leading assets when analyzed rigorously. The second objection is volatility. The appropriate response is to quantify the volatility contribution at realistic allocation sizes. A 2% allocation to an asset with 65% annualized volatility contributes approximately 1.3 percentage points to total portfolio volatility, a meaningful but manageable addition for most multi-asset mandates that is offset by diversification benefits from the low correlation to traditional assets. The third objection is regulatory uncertainty. The response must acknowledge that uncertainty exists while pointing to the concrete clarity that has emerged. Spot ETF approvals, SEC's implicit commodity treatment of Bitcoin and Ethereum, and FIT21's congressional progress all represent meaningful, if incomplete, regulatory clarification. A sequential implementation roadmap for institutions ready to formalize their crypto governance framework. Step 1. Commission rigorous internal analysis before any committee presentation. The investment team must develop a clear-eyed, data-driven assessment of digital assets that can withstand scrutiny. This includes return history across full market cycles, correlation analysis to existing portfolio holdings, drawdown stress tests, peer institution benchmarking, and regulatory status summary. The analysis should be specific to your mandate, not a generic crypto overview. Step 2. Engage crypto-qualified legal counsel for regulatory assessment. Different mandate types, registered investment advisor, family office, ERISA plan, endowment, face different regulatory frameworks. The legal assessment must be specific to your institution's regulatory environment. Step 3. Draft all 7 policy sections with specific parameters. The policy should be specific enough that any authorized allocator can execute within it without requiring discretionary interpretation. Vague policies create the same governance problems as no policy. Step 4. Present to the investment committee with structured scenario analysis. Address the standard objections analytically. Document all questions and responses in meeting minutes. Step 5. Obtain formal ratification, begin custodian onboarding, and establish the quarterly review rhythm from the first day of the allocation. The policy lifecycle does not end at approval. Ongoing governance requires active maintenance. Building a defensible institutional crypto framework requires the same analytical rigor you apply to every other asset class in your portfolio. Crypto Mechanics provides the research, frameworks, and institutional perspective to make that work credible, thorough, and professionally sound. Subscribe now. Your investment committee deserves analysis at this level.